like you said, we're joined in the studio by Bismarck Rewane to take a look at the inflation numbers. Yesterday, we saw the figure out at 13%, a revised figure, as you mentioned in top stories earlier. We saw June inflation up to 14%, revised from the 10.3%, which it was before this latest announcement. So joining us to get a sense of what exactly has happened with the inflation numbers is Bismarck Rewane, CEO, Financial Derivatives. Thanks so much for coming on to the program.
Thank you, Wole.
Let's start, first of all, with the significance of what has exactly happened. I pick out two things. One, obviously, is that they've rebased the index. It's no longer a start date of May 2003. It's now November 2009. And the second, obviously, is that there's a reweighting of the basket of components. Food, for instance, the composition of food in the basket is now down from 64% to 51%. But, what's the significance of this?
Two things. One, the question of data integrity is now a front-burner issue in Nigeria. So the Bureau of Statistics cannot just issue data and think that nobody's going to question it. Secondly, it's conforming best practice. And the basket must be reflective of what behavioral patterns are in a country. So yes, it's moving in the right direction. It's not adequate and not fully realistic, but it is a move in the right direction. And it gives you a sense of what the consumer price index, especially the urban index, is.
In fact, you have a good point, because I was just reading in the notes recently that Ghana, for instance, the food component is about 45%, in Kenya it's 36%, so we're still somewhat higher than the standards that we should expect. But anyway, coming back to the inflation number now, at 13%, what do you make of that? We heard Sanusi on CNBC earlier this week saying a figure of 99.5% was good for him. What's your thoughts on the trend we're seeing?
Unfortunately, I don't agree with the governor of the central bank. Inflation targeting means that there must be a specific target.
Right.
It's not single digit or what have you. If the target is 10%, we hold the central bank responsible and tell them when it's over 10%, they have to explain. If it's below 10%, then they've achieved. But the reality is that when you have the CPI at 13% and you have short-term interest rates at 2%, the negative rate of inflation, negative rate of return is actually 11% per annum.
Right.
That's a recipe for capital flight, one for a recipe for excessive consumption, and a recipe for deterioration in macroeconomic balances.
Right. Well, I think, you touched about where money market rates are now.
Yes.
And I think it's probably a reflection of, obviously the intervention by the central bank to rescue the banks. And of course, there's the issue of the fact that there's just this risk aversion in the banking sector, which I think over time would change. So, but you're still making a point that it's still a big issue.
It is an issue, because the quantity theory of money and the new quantity theory of money says there's a positive correlation between money supply and prices. And what's more, high-powered money. High-powered money is money that is used for quantitative easing, for example, or ways and means advances for fiscal funding the fiscal deficit. Clearly, there's excessive spending on the fiscal space.
Right.
There's fiscal dominance. There's quantitative easing on the bank resolution. The transmission lag between when money is introduced and when the prices begin to feel the effect is not yet. We are just beginning to manifest at this point in time. Definitely, you are going to see a boom in prices. Prices are going to go up. The currency is going to come under pressure. The reserves are going to thin out. That is the problem we are going to have in the near term.
Okay, I was just going to ask about the outlook. You're already touching on that, because obviously there are quite a few headwinds going forward, and inflationary things that could exert a lot of inflationary pressure. There's obviously the review in the minimum wage, which takes effect in August. We've seen, obviously, the AMCON is coming into play, and the expectation there is going to be a further liquidity injection into the financial system as a result. So putting all this in context, what are your thoughts?
No, the drivers of inflation are going to be: 1, minimum wage; 2, deregulation; 3, fiscal spending. Fiscal spending without a corresponding receipt of quality goods, because this is spending towards an election. 4, the fact that the currency itself, imported inflation, is going to be coming to play. The dollar, which was strengthening over the past 11 months, is going to show signs of weakness. So in all cases, there's going to be some macroeconomic or financial imbalances. But having said that, remember that the stimulus required to take this economy out of a slowdown or out of a recession is required. You can't make omelette without breaking eggs. Therefore, I can live with the natural rate of inflation. The only thing is that the interest rates, the artificially low interest rates today, cannot sustain. The central bank will have to intervene and begin to mop up money very soon.
Okay, and I was just going to ask on the impact of the rates that we're seeing at the level at 13% now on economic growth. We've seen first half GDP up 7%, and to some extent, obviously, you will expect that there's inflation is required for some economic growth. But what are your thoughts on the impact of this?
No correlation between that. The growth figures we're still taking with a pinch of salt. And yes, the divergence between the proxies and the growth figures is narrowing, but it still leaves a lot of there are questions to be answered on that. The growth is actually coming from non-oil, which is food. Weak linkages exist in this economy. But what you're asking yourself, the major objectives of economic policy are: one, to achieve sustained and accelerated growth; two, to sustain it within an environment of fiscal balance. What you are seeing now, there is an artificial sense of fiscal balance. I think with undercurrents of inflation, and even 13% is not hyperinflation. It's fair. It's good. The only thing is that to bring it into balance and equilibrium, you need to bring interest rates so that there's no dis-savings. Okay? Because what you have now is, this is a recipe for excessive consumption, one, if it does follow; two, for money going out in search of yields; and three, it also discourages inflow of money market funds into this market. Right. We have not seen an increase in asset values because of these low interest rates. So when interest rates start to go up, then what is going to happen to the stock market has bottomed out. We are likely to see a rally, but the rally could be muted when we start pushing up interest rates in net.
Sorry,